Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates, 10-year note yields creeping higher since SEP FOMC. Today's closing mark is the highest we've had. It has been in a pretty good range since SEP FOMC, but really that's when things started to turn a little bit more bearish, obviously driving yields higher. We've seen kind of a range trade headed into Thursday's pre-employment trade, and then obviously today we saw things shift a little bit more. So better selling in treasuries, yields going higher ahead of a key data point tomorrow. What did that do to volatility? Well, I'm going to tell you, it didn't go down, which is a good thing because obviously we talk about the volatility levels being so just null and void this year, and not even just this year, going back over the course of years, ever since the Fed really got involved. So volatility is starting to see a little uptick, which is a good thing. When there's uncertainty, when there's angst, when there's a lot of things, a lot of balls up in the air, we should see volatility going higher, and it's been very low for so long that we forget what it's like. So volatility nudging higher, yields nudging higher. What do we have tomorrow for employment? Well, I think employment we're expecting to have kind of that weather, climate-related, hurricane-related numbers that are going to come out, and I think that is going to have an adverse effect on the market because they're going to kind of overlook the fact that they're going to be weaker numbers or lighter numbers that are going to wait until the October numbers come out to really get a clear picture. But ultimately, I think the downside here is that there's been so much insurance, so many puts bought in the Treasury market over the last week or so, that downside will be limited because as we approach those levels, say for instance, as we get towards 240, 245 yield, we are going to see a lot of support there because you're going to have a lot of puts that are going to be exiting the market. So I think any post-employment trade to the downside has limitations, at least in the short term. I think longer term, you're going to look at why would people be loading up on puts? Why would we be thinking the Treasury market's going to reverse here, aside from what the Fed said? Well, we've got a new Fed chairman going to be announced in the next 2 weeks. We've got SEP FOMC minutes next week, both of which could be very bearish to the market. So I think over time, the puts that have been bought are going to pay off. However, tomorrow, I'm not sure we'll get it in there, but downside could be limited for tomorrow. We head into employment on the highs, yield-wise. This has been Todd Colvin coming to you from the floor of the CME Group.